Welcome to the Passive Income MD podcast, where we talk about creating your ideal life through multiple streams of income. If you enjoy hearing about this stuff, make sure to hit subscribe. Now let's get on with the show.
Hey everyone, I'm excited for this conversation. I've been trying to have this for a while because I think it's an exciting new opportunity or a really cool asset class, I'd say, within real estate, a different way of thinking about investments. And I thought if I'm learning about it, you should know about it too. And I'm excited to have Jesse Stein here. He is the CIO or Chief Investment Officer at HomeShares. He's going to be helping us understand this whole concept of home equity agreements, how we can invest in it, what kind of benefit we might get out of investing in it, and just learn more about the subject. So I'm just excited he could sit down with us today. Jesse, how you doing?
Hey, Peter. I'm good. Great to be here.
Thanks for joining us. Can you tell us a little bit more about your background? I know you're the Chief Investment Officer there, but just tell us a little bit more about your experience so we understand how you got to being there at HomeShares.
Sure. I started my career, I was an equities trader, then decided I wanted to get into real estate. So I started my real estate career around 2005 in investment banking, raising equity, debt syndication, and then started my first company in 2012 called HEAs Financial. And at HEAs, I built a trading platform specifically designed for real estate securities, licensed that to E-Trade, also partnered with NASDAQ on a series of REIT indexes. So I've been creating kind of niche type real estate investment products since then. After HEAs, I created a company called Compound where it was a mobile app where investors could invest in individual properties and sold that to the investment platform Republic. And at Republic, I was the head of real estate. And while I was there, I met the NADA team and we entered into a joint venture and partnered on a series of funds called City Funds that were investing in home equity agreements. So I've been involved with NADA for about 4.5 years now. Initially as that joint venture partner, I was on the board for a couple of years, and I joined full time as the Chief Investment Officer in March of this year in conjunction with us launching our new fund, U.S. Home Equity Fund.
Cool. Can you clarify for me a little bit? Like I know NADA is also the name of the team there, NADA, as well as HomeShares. Tell me what those names mean, or are they the same entity, or tell me.
NADA is the parent company of HomeShares. HomeShares is really the brand around the investment products, but they're pretty synonymous, NADA and HomeShares.
All right, that's good to know. So again, when I heard about what you guys did, I thought it was really fascinating. I wanted to have a discussion about it because oftentimes we all are aware of ways to invest in real estate. We talk about having your own properties, investing passively through some syndications, maybe even just investing in debt, having the note and investing that way. But what you guys do is a little bit different. So can you share a little bit about what that is? Like, I'm assuming we're going to be talking about home equity agreements here. So we'll start with that. Just tell us maybe in a brief couple sentences, like what that is, and then I'm going to dig into it a little bit.
Yeah, you're right. It is a different type of real estate investment. At its core, it's probably the most simple real estate investment that you can think of. However, it is not something that people necessarily know that is available from an investment perspective. I think it's important to start at the market level. And you talk about residential real estate in the U.S., single family residential real estate, it's almost $50 trillion of asset value. And a lot of people are surprised to know that that consists a lot more of equity than of debt. The equity portion is 3 times the size of the debt portion. So there's over $30 trillion of equity in residential real estate in the United States. And what has happened over time is that a lot of homeowners have owned their homes for decades, 10, 20, 30 years. And they've built up a significant amount of equity. This is their largest asset that they own. A lot of their net worth is tied up in their house, but they can't access that. It's illiquid until they sell their home. Until they refinance, they're not able to pull out that equity. And what has happened is that as interest rates have risen, it's made it even more difficult for people to pull out that equity. So along comes the home equity agreements. Home equity agreements, it solves this problem. It helps homeowners unlock this equity. The product has actually been around for about 20 years, but it's really the macro environment of the past few years that have really made this an attractive asset class. And what it is it's an agreement between us as the investor to provide a homeowner with cash upfront. In exchange for a percentage of the home's future value. So these are 10-year contracts These are not debt contracts. There's no interest payment. The repayment to us is upon the sale of a house, upon a refinance. And it's just a really different product. The use of proceeds for a homeowner can be used for really anything that they want. It can be used for home improvements. It can be used for debt consolidation. It can be used for a life event, such as paying for your kid's college or to take a dream vacation. So we're providing this liquidity to homeowners, but it's really a great investment product at the same time.
Okay. First of all, great explanation. I think so let me see if I understand this correctly. So let's just run through a scenario for myself and my home. I bought my home even just about 4 years ago, but since the market's been real hot, the value of interest equity has gone up significantly. And I'm in a place, you're right, where I bought my house at a pretty low interest rate. And so I don't have an interest in, I'd say, refinancing right now. And maybe I can get a HELOC, home equity line of credit, and access some money there. But are you saying like that type of person would be somebody that would come to you and say, hey, I'd love to find a way to unlock some of that equity up front so they can get some cash from that? Is that right?
Pretty much. But what you've also seen in the US is that on the demographic side, homeowners have become older, right? So you have a lot of our customers are in their 50s, their 60s. The equity value of their home has risen significantly over the past 20 years. Their incomes may not have risen at the same pace. And because of that, they don't necessarily want to incur additional debt through a HELOC type product or through a refinance. And even today, a lot of those homeowners have 2, 3, 4% mortgages. They're not going to refinance at 7, 8%. So it's this perfect storm of demographic of home ownership together with the difference in interest rates today compared to a few years ago, where the demand for this product on the homeowner side has just really taken off the past few years.
Essentially, that home equity that they have locked in here, or whatever they even think it'll grow in the future, they're basically selling some of that essentially to you. And so you as like an investor, I'm assuming would at the time of sale, you have a percentage, I'd say, of whatever that equity becomes. Is that the way it works?
Yeah, and the structure of it is really what's exciting from the investor perspective. So think of it as preferred equity in a home. The way that we structure that is that there's an exchange rate. So let's say your home is worth $1 million and you want to take out $100,000. We provide you with a check for $100,000. Day one, we have a $185,000 position in your home. So there's a 1.85 exchange rate. And what that does for us is it over collateralizes our investment so that not only over the long term are our returns greater than the actual home price appreciation of that home, but more importantly, it provides us with a significant amount of downside protection. Because even if that home declines in value over the next 3, 5, 10 years, we don't necessarily lose money. And this is what has started to attract, hundreds of millions of dollars of institutional capital into this asset class, is you get the best of both worlds. You have the protection that you see in a debt product, but you're not necessarily giving away any of the upside that you see in an equity type product.
How did you guys end up figuring out that this was a viable path for you guys in terms of an investment? Like, it sounds like you got to find both sides. You got to find people that are willing to obviously invest in this. And then you got to find homeowners out there who are willing to, in exchange for some capital up front, right? Some liquidity, are able to do this. Like, how did this all come together?
We are currently one of 5 of the leading originators of these products. And in total, the industry is north of $2 billion for 2025. So we are not the only company in the market that are providing these products to homeowners. We are the only one of those originators that are also raising capital from individual investors. So we are a bit different there. It's really a trend in the home equity financing space that we've been keeping track of for a few years. We started originating these products in 2022. Our team has a deep background in the mortgage and home equity space, decades, and have raised billions of dollars of those type of products. So as this was starting to gain traction, they caught wind of it. They saw interest rates were rising. They saw demand for this type of product would be there. And John Green, who's the founder of Nada, made the decision to move the company into this product exclusively.
I mean, I think it's cool. So let's talk about what this looks like for an investor, because I'm always curious about looking into different types of investments in real estate. And of course, usually I always tell people there's like a spectrum from more active real estate investing to more passive real estate investing. I think it's all kind of passive income in the sense that, it's income that maybe you're not putting in like trading time exactly for, and it can scale and lever over time. Now, where would you put this on the spectrum for an investor from like the more active investing to more the passive investing when it comes to real estate?
Yeah, I think there's two levels there, right? It's you as the investor. Are you being active or are you being passive? If you go out and you buy a home and you have to deal with renting it to tenants and you have to deal with maintenance, right? You're an active investor at that point, right? Not a lot of people want to do that. It's very difficult. There are a lot of risks. It's very time consuming. Let's assume most investors want to be passive on the real estate side, right? So they're investing in real estate syndications, they're investing in real estate funds, they're investing in REITs. But then you look at the whether it's passive or active at the property level, right? So think of a typical commercial real estate syndication deal. That is an actively managed deal, right? Typically it's, I'm going to go and buy an apartment building. I'm going to do some renovations, add some value. I'm going to lease it at a higher, rental rate, and the property is going to be worth more money. A lot of active management is necessary there at the asset management level, at the property management level. There's a whole entire strategy that needs to be executed. Here, we are entirely passive, where for each investment we make, there's a built-in property manager, meaning the homeowner. Then the homeowner has to deal with maintenance, capital improvements, paying insurance, paying taxes. We don't have to deal with tenants. We don't have to deal with vacancy. We are letting the market generate our returns and the structure of these products. And as part of that, what's important here is to invest in a diversified, large pool of assets, similar to a mortgage. You don't want to invest in a single mortgage. You want to invest in a pool of mortgages. So it's similar here, where we've created a pool of assets and we're continuing to build that pool of assets to create diversification, but also to manage cash flows around repayments.
You said you're letting the market do the work. So, in today's environment, when we're at the time we're recording this right now, obviously we've gone through this period of high inflation and maybe it's cooled off to a bit, but people expect some of that to come back. What is your outlook for what the housing market will look like over the next 5 to 10 years and how that might benefit investors that might be into this product?
The thing is, in today's market, real estate specifically, there's just a lot of uncertainty, right? So you can make the case either direction, right? There's a housing bubble on pricing in certain markets and prices are going to come down, or there's a lack of supply and prices are going to continue to go up. And interest rates, who knows which direction they're going, right? Most people assume they're going down, but there's potential for inflation and they go up. This is a really defensive type investment where macro events like the bat, aren't going to play that much of a factor in our ultimate returns. So we'll make better returns if home prices go up, but we're not dependent on home prices going up 10, 15% over a 5-year period in order to generate decent returns. So there's really two factors at play for determining our returns. It's that home price appreciation, which is less important, but then also when these contracts are repaid. So the sooner they're repaid for us, the higher our return. We have a 20% annualized cap on each of these contracts. So if any homeowner would repay us in the first 3 years, we've made a 20% annualized return regardless of what that home price has done, unless it has dropped like 50% or so. At that point, our investment may be impaired, but there's so much downside protection that over that short term, I'm almost indifferent whether home prices go down 5% or up 5%.
Okay, so let's talk about that so I understand that. So you said at the exit, and I know you mentioned before, some of these are longer holds. So it sounds like the returns really come into play when you said there is some event, whether it's they either refi their property or they sell their property. When should people expect most of this stuff happens for people? I've heard some different numbers out there. Could they just hold for indefinitely? And how does that impact returns?
Each home equity agreement is a 10-year contract. So upon, the 10-year anniversary of the origination, there's a balloon payment that is due. Now, ideally, the equity in that home has increased from the home increasing in value. And at that time, if a homeowner needs to refinance either with a new home equity agreement or through another debt type product, they would be able to do that, but we would get repaid there. But industry-wide, about 10 to 15% of these contracts get repaid organically every year from people selling homes, from people refinancing, from people coming into money and repaying us. So a decent percentage of the portfolio will just repay over time. But where we're actually looking to generate returns is in the securitization market, as well as in bulk sale market. So we don't expect to necessarily hold these contracts until that 10-year term. First thing on the securitization market, for those that aren't familiar with securitization, you take a pool of assets and you create bonds, fixed income securities, and institutions buy these bonds. It's basically a refinance at very attractive levels. But what it allows us to do is pull out a lot of the capital that we've invested and distribute that back to investors. So our strategy is to participate in a securitization transaction for these assets within the first 2 years of our fund's life, at which point we'll be able to return 50 to 100% of investor capital. Following that, in addition to the organic repayment of these assets, there's also a secondary market for home equity agreements, and we would sell the remaining portfolio either in a bulk sale or to another fund and distribute those proceeds to investors.
Oh, that's really interesting. Okay. So that I'm learning new, because again, I thought it was kind of like a 10-year hold. You got to wait for this big liquidity event. You got to wait this entire time, which again, it can add up over time. I didn't realize there was all these different kind of exit points or ways that these things are structured to be able to even create returns for the investors sooner. Now, here's an interesting fact. There's over $35 trillion in home equity in the US right now. And with housing stock values nearly tripling since 2013, it's one of the biggest and fastest growing markets out there. So until recently, investing in that growth was something only big institutions could do. Now, there's a company called HomeShares that changes all of that. They have a fund called the U.S. Home Equity Fund that gives accredited investors a way to access residential real estate appreciation without owning or managing a single property. Now, here's how it works. The fund provides cash to homeowners in exchange for a share of their home's future appreciation. Now, when the home is sold or refinanced, both the homeowner and the fund share in the gains. And because the fund invests at a discount to the home's value, you have built-in downside protection if prices dip. So you get nationwide diversification designed to spread risk with a targeted 14 to 17% annualized return over a 5-year term. And it's professionally managed, so you don't have to vet or track individual deals yourself. You can learn more at homeshares.co. That's homeshares.co. What if you could catch PIMD Con, the Physician Real Estate and Entrepreneurship Conference, without booking a flight? The PIMD Con 2025 virtual ticket lets you join live from anywhere. Grab your friends, your team, or colleagues, and experience the event together from wherever you are. You'll earn CME, watch every featured session via live stream, and get lifetime access to the recording so you can rewatch anytime. You'll also get access to our vetted sponsors and partners online. So if you decide to act on an idea, you know exactly who can help you put it into practice. Now, after the conference, we're going to keep it going with PIMD Con Encore Nights, where I'll host small group breakouts, live speaker Q&As, and targeted networking, all done virtually. So bring your questions, get real-time feedback, and leave with a plan you feel good about. And here's the fun part. You don't have to experience it all alone. Now, invite your friends, your team, or colleagues to join you online and save up to 50% with group ticket discounts. Now, we've packed this year's agenda, and I couldn't be more excited. So if travel's not in the cards for you, I get it, but I still want you there. The virtual ticket really is the next best thing to being in the room. So grab your virtual ticket at PIMDcon.com. That's PIMDCON.com. See you online. Now back to the show. I think one of the things that also you mentioned, and I think we should talk a little bit more about, is you mentioned the downside protection. You mentioned like there's a, automatically you get, I don't know, let's say it's $100,000, you get $185,000 of equity in there. So explain for people again, if you don't mind going a little bit deeper, like what are all the things you guys have thought about in terms of like what keeps you up at night? Why some of these things might have some challenges? Because obviously with everything in real estate, especially lately, there's been some volatility, there's been some challenges. And so I think a lot of people these days are even more focused on the downside protection. So do you mind if we talk a little bit about that? And so I can understand that a little bit better.
Sure. I'll just run through the same example again using slightly different format. So you have your $1 million house, okay, and most of the homes that we work with, there is a first mortgage, though that averages about 35% loan to value, and our capital is usually coming in between 35 and 55% loan to value. On average, we're at 50% loan to value, including our investment. But let's say you have $1 million home, and there's a $300,000 mortgage, and we invest $200,000 on top of that. So day one, we have $360,000 of collateral. Okay. Now, let's say that $1 million home declines by 20% to $800,000. Okay. There's still $500,000 of equity left in that home. So our $200,000 is not impaired at all. Okay. And that's with a 20% decline in home values. If home values across the board decline 20%, we all have a lot of problems beyond, these investments, right? The economy must not be doing well. I'm sure the stock market would tank at that point. And in fact, a home can decline 5% every year for that entire 10-year period, and our investment wouldn't be impaired. We wouldn't make a lot of money, but we wouldn't lose any money on that specific investment. So that's why I'm saying, hey, if home prices rise, great, we'll make even more money. But if they decline, if they stay flat, it's not like we're still not going to make a nice return on our investment.
Got it. So let's say this property does sell and it's underwater, or the value has dropped significantly. It sounds like there's always a primary loan. So that usually gets paid off first, and you guys are paid off next, right? I would say that's kind of what, in terms of priority.
Yeah, our contracts, there's a lien that's filed with them. We're typically in the second position. A homeowner wouldn't be able to refinance their first mortgage without repaying us or getting our approval. If a home is sold, title picks that up and pays us back upon the sale. So it's very similar to a second lien preferred equity type position is the best way to compare it to a more typical type real estate investment.
People that come to invest, they're not like trying to pick the winners and losers, right? On type of, not winners and losers, but they're trying to pick the single properties. Are they making determination? I think this is set up like a fund.
It's a fund. The fund officially launched in March. We had our first closing in May. We currently own about 140 home equity agreements, totaling about $12 million in asset value. And it's that diversification, that's very helpful. I wouldn't advise anybody to invest in a single home equity agreement. But when you are able to invest in a pool, you're able to realize that 10 to 15% annualized repayment for the portfolio. And it gives you a lot more opportunities from an exit strategy and the ability to securitize those assets and then ultimately sell them in bulk to another investor.
Now, as interest rates, if they do decide to fall a little bit, right now homeowners, there's a lot of things that make this really, really desirable. Is there anything that might change in the future that you guys are concerned about or worried about in terms of the way the macroeconomic environment might happen that would make owners like maybe less likely to go through this process? Or is it still really appealing no matter what environment we're in?
I think it's appealing to certain homeowners regardless. There are a lot of homeowners that just do not want to add any additional expense to their lifestyle, regardless of whether it's a 3% mortgage or a 7%. And you mentioned HELOCs previously. It's interesting. HELOCs are a huge, huge market. I think it's $100 billion or so. About 50% of applicants get turned down for HELOCs. And, usually that's because, they have plenty of equity, but they may be retired and they don't necessarily, fit the underwriting criteria from an income perspective. Now, those type of clients are great for us. We're less concerned with their income other than do they have the ability to pay their first mortgage, because we don't have interest payments, right? As long as there's an ample amount of equity in that property, we're happy, underwriting. The opportunity for us exists for this product, I think regardless, but what would happen is there would certainly be a drop in demand from people who would otherwise refinance at 3-4%. Now, that may make it a little bit more difficult for us to originate these assets. But what it also does is it means that the assets that we're holding are getting repaid more quickly. And that's going to increase the returns on our existing portfolio. So it's not so great on one side, but it's good for the existing portfolio.
You know what I think is really interesting? I don't even think there are a lot of people. I mean, it's great that you guys were able to originate so many already, and it's this huge market now. But I'll be honest, even as a homeowner, I didn't even know this was an option. So my assumption is that over time, as even people figure out that this is even more viable option, that this market even grows. Am I right in thinking about that?
It is very early for these assets, but we've seen tremendous growth over the last couple of years. I think there's been 100% industry-wide growth. The securitization market, I mentioned this, is going to be north of $2 billion this year. And you have big institutions now playing in this space, putting hundreds of millions of dollars of capital behind these products. And, as part of that, it allows companies like us to bulk up marketing and originations, and the product will become more common over time.
Got it. Do you mind sharing a little bit about the taxes on this a little bit? Is there, we always talk, taxes are a big part of some of these investments, or understanding this part. Like how is some of this income treated when you're part of this fund for investors, just so they know?
The fund is a Delaware limited partnership, so it's a pass-through entity. Investors will receive a K-1, at the end of each year. From the fund's perspective, the majority of the profit will be capital gains, other than if a home equity agreement is repaid, prior to 12 months, then it would be short-term capital gains. The profit is primarily capital gains. And as we make distributions, those will be a mix of a return of capital and capital gains passed through to each investor.
Got it. Okay. That's good to know. I'd say whenever I look at different investments and I'm trying to figure this out, like what kind of, I'm trying to create a good portfolio, a good mix based on, what I think what's ideal for me, right? And whenever people are looking at investments, I always say, hey, does it fit your profile? Is it what you're looking for in terms of characteristics? And a lot of times certain type of people or what they're looking for gravitate towards certain type of investment. So maybe I'd love to hear from you, like what type of people or investors are gravitating to your type of investment, like to your investment? Like what are they looking for when they say that? Like I'm sure there's a couple of buzzwords or key things that they're looking for that make this thing so attractive to them.
Yeah, we have a lot of interest from investors who are participating in our fund through IRA. That makes a lot of sense because this type of asset, it doesn't have a defined stable dividend. This is not necessarily an investment for someone who wants to live off of the income that this investment generates. But when you're talking about retirement savings, right, this is a relatively safe real estate investment. You're not giving up on your returns necessarily. We're targeting 14 to 17%, which is in line with a lot of real estate equity type investments. So, by putting this in an IRA, your capital is somewhat protected, but you're not necessarily giving up the growth on that capital. So we see a lot of investors who are investing through their IRA, and then even though it is technically real estate, as we discussed, it's different than other type of real estate investments. So I think it's a way to diversify within your real estate portfolio. If you're already participating in real estate through, physical properties, whether doing it by yourself or, through a fund or a syndication, this is kind of like a quasi-private credit, structured product on the real estate side. So it's different in that respect, but, can help diversify, within your real estate allocation or overall as well.
Where do you see HomeShares going here in the next 3 to 5 years? I'm just curious what the direction is for you guys. And are there different asset classes that you can also target in terms of, right now you're targeting the residential market, but are there any other kind of asset classes that you might go into? I'm just curious if there's any sort of new things down the road for you guys that you might expand into.
We 100% believe that the home equity agreement market is just a tremendous opportunity at this time, as far as it being early, and the macro environment just providing, so much momentum in that direction. So today we're fully concentrating on this product. But what we are able to do is our origination team, has background in multiple different type of products and mortgages and HELOCs. And where we can expand there is all of these homeowners will ultimately come back for another product. And if we're able to refinance their debt with a mortgage, that's good for us. If we're able to put them into a HELOC, that's good for us. So I think there'll be expansion on the origination side. On the investment side, right now, we're focused entirely on home equity agreements, just considering, the opportunity that we see there.
All right, well, there you have it. I think a lot of people probably, might fit into a couple camps. There might be people who realize there's other ways to unlock the home equity that's in your home, which I think is cool because we're always looking for different ways to do that and create liquidity or figure out where to get funds for different, different uses or purposes. And then there's this other side where most people, there are probably a group of people that didn't even realize you could invest in this, which is really fascinating. And so I feel like we learned a lot on this call. So I really appreciate your time. This is awesome. So if somebody wants to reach out to you or to HomeShares, wants to find out more, where's a great place for people to do that?
Our website is homeshares.co. My email is jesse@nada.co or jesse@homeshares.co. But I suggest you start on the website. There's a lot of information there, a lot of documents. But if anybody's interested in speaking with me directly, always happy to speak with potential investors.
Cool. Well, thanks again for taking the time. I'm sure this is not the last time we'll be talking about this. There's probably some other things I'd love to dive deeper into with you. But if anybody's listening to this and they think it's fascinating, you should definitely reach out to Jesse or to HomeShares. You can go ahead on the website and check that out. But again, I appreciate your time. Thanks for doing this. Let's do this again soon.
Yeah, thank you, Peter. Appreciate it.
Okay, bye.
Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.